Jamie Dimon runs the largest bank in America. In October 2025, he told the BBC something he's never said publicly before. The stock market has a 30% chance of crashing within the next 6 months to 2 years. Not 10% like the market thinks, 30%. And then he said something even more disturbing. When you see one cockroach, there are probably more. He's talking about the bankruptcies starting to appear, the cracks in the system, the same warning signs he saw in 2008. Think about what that means for a moment. This is Jamie Dimon, the man who survived the 2008 financial crisis, while Lehman Brothers, Bear Stearns, and Washington Mutual collapsed around him. The CEO who's been running J.P. Morgan Chase through every market crisis since the year 2000. He doesn't do panic. He doesn't do predictions. And he definitely doesn't go on international television to warn about crashes unless something serious is happening behind the scenes. On October 8, 2025, Dimon sat down with the BBC and said he's far more worried than others about a market correction coming. The stock market had just hit its 33rd record high that year. Everyone else was celebrating. Meanwhile, Dimon was doing math that should terrify anyone paying attention. He told them the crash probability isn't the 10% that traders are pricing into their models, it's 30%. 3 times higher. And here's the kicker. He gave them a timeline, 6 months to 2 years. That means this could start as early as April 2026, or drag out until October 2027. But here's where it gets really interesting. 8 days later, on October 16th, J.P. Morgan held its third quarter earnings call. Analysts asked about some bad loans the bank had written off. Dimon could have given them the standard corporate answer about risk management and diversification. Instead, he said this: "When you see one cockroach, there are probably more." That's not banker speak. That's a warning. The cockroach he was talking about? A Dallas-based company called Tricolor Holdings that went bankrupt in September 2025. You've probably never heard of them, but they're important. Tricolor specialized in subprime auto loans, lending money to people with bad credit who needed cars to get to work. Think of them as the 2025 version of those subprime mortgage lenders that triggered the 2008 crash. Same business model, different asset. They package up risky loans, sell them to investors who don't ask questions, and pocket the fees while the risk spreads through the financial system like a virus. When Tricolor went bankrupt, it cost J.P. Morgan about $170 million. For a bank that size, that's pocket change. But it's not about the money. It's about what it represents, because Tricolor wasn't alone. A month earlier, in September, another subprime auto lender called First Brands also went bankrupt. Same business model, same risky loans, same outcome. That's 2 cockroaches Dimon has spotted so far. And if you know anything about cockroaches, you know they travel in groups. Now pop quiz. What do you think happens when the CEO of America's largest bank goes on television and compares current bankruptcies to pests multiplying in the walls? You'd think the stock market would panic, right? You'd think investors would start asking questions, maybe sell a few positions, play it safe for a while. But here's what actually happened. Nothing. The S&P 500 kept climbing. Tech stocks kept soaring. Everyone kept partying like it's 1999. And that's exactly what worries Dimon. He's seen this movie before. In his October interview, he specifically called out artificial intelligence valuations as entering bubble territory. According to the Bank of England's October 2025 report, AI stock prices seem inflated and carry the risk of a sharp correction. Translation: the smart money thinks AI companies are wildly overvalued, and when reality hits, the crash will be brutal. But retail investors, the everyday people putting their retirement savings into these stocks, they're not hearing the warnings. They're too busy watching their portfolios go up. Here's a number that should grab your attention. The top 10 companies in the S&P 500 now represent 40% of the entire index. That's a record concentration. It means our stock market has never been more dependent on a handful of tech giants, most of them riding the AI hype wave. If those 10 companies stumble, the whole market stumbles with them. It's like building a house where 40% of the weight rests on 10 wooden posts. Sure, it looks stable when everything's going well, but what happens when one of those posts starts to crack? Dimon knows what happens. He watched it unfold in 2008 when Subprime mortgage lenders started failing one by one. He saw how everyone dismissed the early bankruptcies as isolated incidents, nothing to worry about, just some bad actors getting cleaned out. Then the contagion spread. Then the panic hit. Then Lehman Brothers collapsed and the entire global financial system froze for 72 hours, while central banks scrambled to prevent a complete meltdown. That's why his cockroach comment matters so much. He's not making a casual observation about some bad loans. He's telling you, in the clearest language a bank CEO can use without causing a panic, that what we're seeing now looks exactly like the early stages of 2008 small failures in the subprime lending space. Bubble valuations in a hot sector everyone thinks is different this time. Record highs in the stock market while cracks appear in the foundation. And just like 2008, everyone's ignoring the warning signs because making money feels too good to stop. You have to understand something about Jamie Dimon. This man doesn't say things like this lightly. When he compares our current situation to cockroaches hiding in the walls, he's drawing on 38 years of experience navigating financial crises. He survived Black Monday in 1987. He watched the long-term capital management collapse in 1998. He lived through the dot-com crash. He not only survived 2008, he used it to make J.P. Morgan stronger by buying Bear Stearns for $2 a share when everyone else was bleeding out. If there's anyone in American finance who knows what the early stages of a crisis look like, it's him. So, when this man, with this track record, goes on international television and tells you there's a 30% chance of a crash in the next 6 months to 2 years, you should probably pay attention. Because unlike you and me, he can see the data the market doesn't show. He knows which companies are struggling with their loans. He sees which sectors are wobbling. He has access to information that won't hit the news until it's too late to do anything about it. The stock market hit 33 record highs in 2025, while Dimon was raising red flags. That disconnect should tell you everything you need to know about where we are in this cycle. The party's still going, the music's still playing, and everyone's having a great time. But the man who's been to this party before is standing by the exit, watching the room carefully, and quietly suggesting you might want to know where the door is. Because in his experience, when you see one cockroach, there are always more hiding in the walls. And the longer they stay hidden, the worse it gets when they all come crawling out at once. Here's what you need to understand about financial crises. They always start small. One company fails. The market shrugs it off as an isolated incident. Then another company fails. Still isolated, they say. Then 5 more fail. Then panic. Then systemic collapse. This pattern has repeated itself so many times in American financial history that you can practically set your watch by it. And Jamie Dimon has lived through every single one of these cycles since 1987. Let's start with the crisis. Dimon knows best because he didn't just survive it, he used it to become more powerful. March 2007, a company called New Century Financial filed for bankruptcy. If you weren't paying attention to finance back then, you probably missed it completely. New Century was a subprime mortgage lender based in California. They specialized in lending money to people who couldn't afford traditional mortgages. People with bad credit and unstable income sound familiar? It should, because it's exactly what Tricolor Holdings was doing with auto loans before they went bankrupt in September 2025. When New Century went down, the financial media covered it for about 48 hours and then moved on. Analysts went on television and said the same thing they always say. This is an isolated incident. The fundamentals of the housing market remain strong. There's no systemic risk here. Jamie Dimon was running J.P. Morgan at the time. He read those reports and he didn't believe a word of it. 3 months later, in June 2007, 2 Bear Stearns hedge funds that were heavily invested in subprime mortgages collapsed, lost everything. Again, the market treated it like an isolated problem. One investment bank having a bad quarter. Nothing to see here. Keep buying stocks. But Dimon was watching the pattern develop. He'd seen it before. He knew what came next. What came next was 15 months of small failures that everyone kept calling isolated incidents, right up until September 2008, when Lehman Brothers collapsed and the entire global financial system locked up like an engine that ran out of oil. Banks stopped lending to each other because nobody knew who was holding the bad mortgages. Credit markets froze. The stock market went into free fall. The government had to step in with $700 billion in taxpayer money to prevent a complete meltdown that would have made the Great Depression look mild. But here's the interesting part. J.P. Morgan didn't just survive. They thrived. In March 2008, when Bear Stearns was on the verge of bankruptcy, the Federal Reserve arranged for J.P. Morgan to buy them for $2 per share, $2, a company that had been worth $70 per share just 6 months earlier. Dimon got the deal of the century because he'd prepared for the crisis while everyone else was pretending it wasn't happening. He'd built what he calls a fortress balance sheet, holding extra cash and avoiding the riskiest loans while his competitors were gorging themselves on subprime mortgage fees. That's why his cockroach comment in October 2025 should send chills down your spine. He's using the exact same language he used internally at J.P. Morgan in 2007. When you see one cockroach, there are probably more. He's telling you in the clearest terms a bank CEO can use that what's happening right now with subprime auto lenders looks exactly like what happened with subprime mortgage lenders 18 years ago. But let's go further back, because this pattern is older than 2008. September 1998, a hedge fund called Long-Term Capital Management collapsed. This wasn't some sketchy subprime operation run by guys in cheap suits. LTCM was run by Nobel Prize winners, literal geniuses with PhDs in economics and mathematics. They'd built complex computer models that were supposed to eliminate risk through sophisticated hedging strategies. The smartest people in finance were running this fund, and they lost $4.6 billion in 4 months. How did it happen? Russia defaulted on its debt, which wasn't in their models. Their supposedly risk-free strategy turned out to be catastrophically risky. When the unexpected happened, the Federal Reserve had to organize a $3.6 billion bailout involving 14 major banks, including J.P. Morgan, because LTCM was so interconnected with the financial system that their failure could have triggered a global crisis. And once again, everyone said it was an isolated incident. Just one hedge fund that got too clever. Nothing systemic to worry about. Except it wasn't isolated. The Asian financial crisis was spreading, countries were defaulting, markets were wobbling. LTCM was just the cockroach that everyone could see. There were plenty more hiding in the walls of the international banking system. The lesson from 1998 is simple. When the smartest people in finance tell you they've eliminated risk with complex models, run the other way. Because risk never disappears. It just gets hidden in places you're not looking until something unexpected happens and it all blows up at once. Now, let's talk about a pattern that should sound very familiar if you've been paying attention to artificial intelligence stocks lately. March 2000. The NASDAQ stock index peaked at 5,048 points. Internet companies that had never made $1 of profit were trading at 100 to 200 times their revenue. Not their earnings, their revenue, because most of them didn't have any earnings. But that didn't matter. Everyone said, this time is different. The internet was going to change everything. Traditional valuation metrics didn't apply anymore. We were in a new paradigm. You know what happened next. Between March 2000 and October 2002, the NASDAQ crashed 78%. $5 trillion of market value evaporated. Companies that had been worth billions went to zero. Pets.com, which spent millions on Super Bowl ads, sold for $300,000 in a liquidation sale. Webvan, the grocery delivery company everyone said would revolutionize shopping, burned through $800 million and shut down completely. The new paradigm turned out to be the same old story. When valuations lose all connection to reality, gravity eventually reasserts itself. Jamie Dimon was at Citigroup during the dot-com crash, watching it unfold from inside one of the biggest banks in America. He saw how euphoria turns to panic. He watched retail investors who'd mortgaged their houses to buy tech stocks lose everything. And now, in October 2025, when he looks at artificial intelligence stocks trading at 50 to 100 times earnings, when he sees the Bank of England warning that AI valuations seem inflated and carry the risk of a sharp correction, he's seeing the same movie playing again with different actors. The pattern repeats because human. Psychology doesn't change. Greed, fear, euphoria, panic. These are constants. The assets change, the technology evolves, but the cycle stays the same. In the late 1990s, it was internet stocks. In the mid-2000s, it was housing. In 2025, it's artificial intelligence. Each time, everyone says, this time is different. Each time, they're wrong. Let me take you back even further to show you just how suddenly these crashes can happen. October 19th, 1987, Black Monday. The Dow Jones Industrial Average crashed 22.6% in a single day. Not over weeks or months, one day. The biggest single-day percentage drop in stock market history. People woke up that morning with retirement portfolios. By the time they went to bed, they'd lost a quarter of their life savings. What caused it? Portfolio insurance. It was a new strategy in the 1980s where computers would automatically sell stocks when prices started falling, theoretically protecting investors from losses. The problem was that everyone was using the same strategy. When the selling started, it triggered more automated selling, which triggered more selling, which created a cascade that overwhelmed the market. It's exactly like what we're seeing now with AI-driven trading algorithms. When everyone's using the same models, when everyone's making the same bets, the exit door becomes very small very quickly. Dimon wasn't running J.P. Morgan in 1987, but he was working on Wall Street. He experienced that crash firsthand. He felt what it's like when a market that seemed invincible suddenly drops out from under you with no warning. The lesson from Black Monday is that crashes don't always build slowly. Sometimes they happen in hours. And if you're not prepared, if you're fully invested when it hits, there's no time to react. Now let's connect all these dots to October 2025. Tricolor Holdings went bankrupt in September. First Brands went bankrupt right around the same time, both subprime auto lenders. Both following the exact business model that destroyed New Century Financial in 2007. Both representing the kind of risky lending that spreads through the financial system when times are good and everyone's hungry for returns. These are the cockroaches Dimon is talking about. But it's not just the subprime auto sector. Look at the broader market. The top 10 companies in the S&P 500 represent 40% of the index. That's more concentrated than it was in 2000 at the peak of the dot-com bubble. Artificial intelligence stocks are trading at valuations that make even tech bubble-era metrics look reasonable. Nvidia, Microsoft, Google, Amazon, these companies have market values that assume they'll maintain massive growth rates for decades. Maybe they will, but what if they don't? What if AI turns out to be transformative, but not profitable in the way everyone expects? What if the billions being spent on AI infrastructure doesn't generate the returns investors are pricing in? What if competition drives down margins? What if regulation limits applications? What if? These are the questions Jamie Dimon is asking, while everyone else is buying the hype. Financial crises always start small. New Century Financial, in March 2007, seemed like one bad company. By September 2008, it was a global catastrophe. LTCM in September. 1998 seemed like one over-leveraged hedge fund. It turned into a multi-billion-dollar bailout and a preview of broader emerging market problems. The dot-com crash started with a few struggling internet companies in late 1999. By 2002, the entire tech sector had been decimated. The mechanism is always the same. Small failures get dismissed as isolated incidents. The market keeps rising because most people either don't see the problem or don't want to see it. Then more failures happen. Still isolated, everyone says, right up until the moment when it's obvious to everyone that nothing was isolated, it was all connected, and the whole system is in trouble. By then, it's too late to get out. The exits are jammed, the panic has set in, the crash is already happening. Jamie Dimon has watched this pattern play out 5 times in his career: 1987, 1998, 2000, 2008, and the 2020 COVID crash. Every single time, there were warning signs that most people ignored. Every single time, insiders who paid attention to those signs survived while everyone else got slaughtered. And now, in October 2025, Dimon is waving the biggest red flag of his career. When he tells the BBC that the crash probability is 30%, he's not guessing, he's calculating based on everything he sees in the banking system that you and I can't see. When he says cockroaches on an earnings call, he's using language specifically designed to make investors think about 2008, without actually saying this is 2008 all over again and causing a panic. The historical pattern is clear. It has repeated itself over and over throughout American financial history. Small failures precede big failures. Euphoria precedes panic. Bubble valuations precede crashes. And the people who see the pattern early, who prepare while everyone else is celebrating, those are the people who not only survive, but come out stronger on the other side. Dimon survived every crash since 1987 because he recognizes this pattern. He knows what the early stages look like. He knows how quickly isolated incidents can become systemic crises. And he knows that by the time it's obvious to everyone, it's too late to do anything about it. That's why he's warning us now, while the stock market is still hitting record highs, while everyone else is still making money, while it still seems crazy to worry about a crash. Because in his experience, when you see one cockroach, there are always more hiding in the walls, and the longer they stay hidden, the bigger the infestation becomes. So, here's the question you should be asking. If Jamie Dimon has seen this pattern 5 times before, and he's sounding the alarm now, what exactly is he seeing in 2025 that makes this time potentially worse than 2008? Let's start with something that didn't exist in 2008. Massive geopolitical instability on multiple fronts simultaneously. In his October BBC interview, Dimon specifically cited the war in Ukraine, chaos in the Middle East, and rising tensions between China and Taiwan as major factors in his crash calculation. These aren't just news headlines that don't affect our economy. Every one of these conflicts is actively destabilizing the global financial system right now. Think about what war does to markets. It disrupts supply chains. It drives up energy prices. It forces governments to spend money they don't have on military buildups instead of productive investments. And most importantly, it creates uncertainty. Markets hate uncertainty. When investors can't predict what's going to happen next month or next year, they sell first and ask questions later. We're living in the most geopolitically unstable period since the Cold War, and that instability is a powder keg sitting underneath our stock market. Then there's the government spending issue. The United States is carrying $38 trillion in debt. Our government is running deficits of $2 trillion per year. Let me put that in perspective. We're borrowing $2 trillion annually just to keep the lights on, and that's during supposedly good economic times. What happens when the crisis hits and the government needs to spend trillions more on bailouts like they did in 2008? Where does that money come from? Here's what Dimon knows that most people aren't thinking about. Every major crisis in the last 30 years has been resolved by the government stepping in with massive spending. The 2008 bailout was $700 billion. The COVID response in 2020 was over $2 trillion. But we're already so deep in debt that the next bailout might break the government's ability to borrow. And if the government can't borrow to fix the crisis, if we've maxed out our national credit card, then what? That's the scenario keeping Jamie Dimon up at night. Add to this the global remilitarization happening right now. Europe is rearming because of Russia. China is building up its military. The United States is increasing defense spending. All of that money, trillions of dollars globally, is being diverted from productive economic activity into weapons and military infrastructure. That's money not going into businesses, technology, innovation, or anything that generates economic growth. It's just gone, burned up in an arms race that makes everyone poorer except defense contractors. Now layer on top of all that geopolitical and fiscal chaos, the AI bubble that Dimon specifically called out. Remember, the top 10 companies in the S&P 500 now represent 40% of the entire index. Most of those 10 are tech companies riding the artificial intelligence wave. Microsoft, Nvidia, Google, Amazon, Meta. These companies have valuations that assume AI will revolutionize everything, and they'll all capture massive profits from that revolution. But what if the AI revolution is real, but not profitable in the way these stock prices assume? What if building all this AI infrastructure costs way more than the revenue it generates? What if competition drives margins down to nothing? According to the Bank of England's October 2025 report, AI stock valuations seem inflated and carry significant risk of a sharp correction. That's central bank language for this is a bubble and it's going to pop. Here's where it gets scary. Because those 10 companies represent 40% of the index. If they crash, the entire market crashes with them. Your retirement account, even if you think you're diversified across hundreds of stocks, is actually 40% concentrated in 10 companies betting on one technology trend. If that trend reverses, if AI disappoints, if valuations come back to earth, your portfolio loses 40% of its value before you even know what hit you. And remember those cockroaches we talked about? Tricolor Holdings and First Brands weren't anomalies. They are symptoms of a much bigger problem in consumer debt. Subprime auto lending is just one corner of a massive consumer credit bubble. According to Federal Reserve data, Americans are carrying record levels of credit card debt, auto loans, and student loans. Delinquency rates are starting to tick up across all categories. These are the same warning signs that appeared in 2006 and 2007 with subprime mortgages. Except now, the debt is spread across different types of consumer lending. When Dimon raised his crash probability from 10% to 30% in October 2025, he was doing math that factors in all of these variables: geopolitical instability, unsustainable government debt, global arms race, AI bubble, consumer debt crisis, concentrated stock market. Each one of these factors alone would be concerning, all of them happening simultaneously. That's why he's using words like cockroaches and giving specific crash timelines. But here's what you really need to understand. Jamie Dimon isn't warning you because he's worried about his bank. JP Morgan will be fine. Actually, JP Morgan will be better than fine. They'll do exactly what they did in 2008. They'll use their fortress balance sheet to buy failing competitors for pennies on the dollar. They'll emerge from the crisis bigger and more powerful than before. Dimon has been through this cycle enough times to know that crashes create opportunities for banks that prepare properly. The people who won't be fine are the retail investors who are fully invested in AI stocks at bubble valuations. The people who took out subprime auto loans they can't afford and are about to default. The people who assume the stock market only goes up because that's all they've seen for the last 2 years. The people who didn't listen when the man who survived every crash since 1987 told them there's a 30% chance this all comes down in the next 6 months to 2 years. Think about his timeline again: April 2026 to October 2027. He's not saying it'll definitely happen. He's saying there's a 1 in 3 chance, which in finance terms is enormous. If someone told you there's a 30% chance your house will burn down in the next 2 years, you'd buy fire insurance immediately. But because this is the stock market, because stocks went up yesterday and they'll probably go up tomorrow, most people will ignore the warning completely. Jamie Dimon survived 2008 because he saw the pattern early. In March 2007, when New Century Financial went bankrupt, he knew more would follow. He built JP Morgan's fortress balance sheet. He held cash. He avoided the riskiest loans. And when Bear Stearns collapsed in March 2008, drowning in subprime mortgage losses, he bought them for $2 per share in a Federal Reserve-backed deal. He turned the crisis into the opportunity of a lifetime. Now in October 2025, he's using the same language: cockroaches, subprime loans failing bubble valuations, geopolitical chaos. He told the BBC the crash probability is 30%, not 10%. He said it could happen in 6 months to 2 years. That means April 2026 to October 2027. The stock market hit 33 records in 2025 while he issued this warning. The party is still going. Everyone's still making money. The music is still playing. But this isn't some retired CEO making predictions to sell books. This is the man who's been running America's largest bank through every crisis for 2 decades. This is the insider who has access to data. You'll never see who knows which loans are going bad, who can read the patterns in the financial system before they become obvious to everyone else. When someone with his track record and his position goes on international television and warns about cockroaches, you should probably pay attention. Because here's what history teaches us: the crashes always seem impossible, right up until the moment they happen. In 2007, housing prices had never fallen nationally in modern history, so a housing crash seemed impossible.